Okay, so you want to own a used car dealership. You drive past one on a Saturday afternoon. The lot is packed with vehicles. People are test driving cars. Salespeople are closing deals. A used car that cost the dealer $12,000 is being sold for $18,000 to $22,000. That's a $6,000 to $10,000 gross profit on a single vehicle. A dealership moving 30 cars per month generates $180,000 to $300,000 in monthly gross profit. The margins look extraordinary. You don't manufacture cars. You just buy low and sell high. The business model seems simple and obvious. But here's what almost nobody discusses openly about used car dealerships. The dealership that appears to be selling 30 cars per month is often barely breaking even. Some are losing money. The seemingly easy gross profit margins are consumed by hidden costs that most operators don't anticipate until they're drowning in losses. By the end of this, you will know exactly where the money comes from, where it disappears to, what the hidden costs really are, and what separates the used car dealerships that generate genuine returns from the ones that become capital traps disguised as busy operations. What a used car dealership actually sells. The problem with inventory: people assume that owning a used car dealership means you're selling used cars at markup. You are. But that's not where the profit comes from. If you're selling cars at standard markup, the margins disappear into inventory carrying costs and the structural inefficiencies of running a retail car operation. What a used car dealership actually sells is customer financing and the spread between acquisition cost and retail price. But here's the brutal truth. Most used car dealers make money on financing, not on the car sale itself. The car sale is break-even or low margin. The dealer finances the vehicle to the customer through a captive finance company or third-party lender. The dealer captures points and origination fees. This is where real money comes from. But this requires significant capital, credit infrastructure, and regulatory compliance. Most small dealers can't do this. They're dependent on car sales for profit. This is where they fail. The secondary brutal truth is inventory carrying cost. A car sitting on your lot costs money daily. Lot rent, insurance, registration, taxes. If a car sits for 60 days, you've spent $500 to $1,500 in carrying costs. You bought the car for $12,000. Your gross profit was supposed to be $8,000. But $1,000 of that evaporated to carrying costs. Your actual profit is $7,000. But you had capital tied up in that car for 2 months. Your return on capital is now terrible. This is why smart used car dealers run 2 lots. One lot is the retail lot where customers come to buy cars. The second lot is a wholesale lot where cars sit cheaper and move faster. By operating 2 lots with different inventory strategies, you reduce average holding time and carrying costs. You increase return on capital. This is the secret that profitable dealers don't advertise. The full upfront investment, what actually costs money. Everyone talks about the cost of buying inventory. Nobody talks about everything else that eats capital before the first car is sold. Real estate and lot development, $100,000 to $500,000. You need lot space. Minimum 5,000 to 10,000 square feet for a functional dealer. Buying or leasing. Land costs vary wildly by market. Urban locations, $5,000 to $20,000 per month lease. Secondary locations, $2,000 to $5,000 per month. Building out the lot requires paving, lighting, signage, office building. Cost, $100,000 to $500,000. Office and showroom building, $50,000 to $300,000 if you're building office space. Or renovating existing space. Professional appearance matters for retail car sales. Cost, $50,000 to $300,000. Initial inventory capital, $200,000 to $1 million. This is the largest variable. You need 20 to 50 cars on the lot to start. At average cost of $12,000 per car, that's $240,000 to $600,000 in initial inventory. Most dealers finance this through auto wholesalers or lines of credit. Cost, $200,000 to $1 million. Licenses, permits, and compliance, $10,000 to $50,000 dealer licensing. Federal and state permits. Sales tax permits. Bonding. Insurance licenses. Cost: $10,000 to $50,000. Insurance and bonding: $5,000 to $20,000 initially. Dealer liability. Inventory insurance. Bonding requirements. Cost: $5,000 to $20,000. Point of sale and finance systems: $20,000 to $60,000. Sales software. Finance systems. Customer management. Document management. Integration with lenders. Cost: $20,000 to $60,000. Signage and marketing: $20,000 to $80,000. Lot signage. Digital marketing. Facebook ads. Google ads. Craigslist. Auction sites. Building initial customer awareness. Cost: $20,000 to $80,000. Staff and initial operations: $50,000 to $150,000. Sales staff salary. Office manager. Initial payroll during ramp-up. Training. Cost: $50,000 to $150,000. Working capital and reserve: $50,000 to $200,000. Operating expenses during ramp-up. Finance and carry costs. Auctions and inventory acquisition. Contingencies. The real total investment. For a legitimate used car dealership, the total upfront investment is $500,000 to $2.5 million depending on location and lot size. Most dealers finance inventory separately from real estate and operating costs. A $500,000 operating investment at 8% over 7 years is $8,500 per month in debt service, or $102,000 per year. Where the money actually goes, the operating cost reality. Once you're open and buying/selling cars, the costs are relentless. And this is where the used car dealership business reveals why smart operators run 2 lots. Lot rent/facility costs: 10% to 20% of gross profit. A $4,000 monthly lot lease on 30 cars per month at $8,000 gross profit per car, $240,000 total gross, is 1.7% of gross profit. But on 20 cars per month, $160,000 gross, it's 2.5%. On 15 cars per month, $120,000 gross, it's 3.3%. Underutilized lot space devastates margins. Most dealers underestimate lot utilization. Inventory carrying costs: 15% to 25% of gross profit. This is the killer cost. Insurance on 30 cars at $20 to $50 per month per car, $600 to $1,500. Registration and taxes: $500 to $1,500. Interest on financed inventory: $2,000 to $5,000. These aren't once-a-month costs. They're daily. A car sitting 60 days costs $1,500 to $2,500 in carrying costs alone. Multiply across 30 cars and you're paying $40,000 to $70,000 monthly in inventory carrying costs on a $240,000 gross profit dealership. Sales staff labor: 15% to 25% of gross profit. Salespeople are expensive. They earn $30,000 to $60,000 base plus commission. A dealership with 3 to 5 salespeople costs $120,000 to $300,000 annually in salary. On $240,000 monthly gross profit, that's 5% to 12.5% per month. On slower months, it's 10% to 20%. Detail and reconditioning labor: 8% to 15% of gross profit. Cars need to be cleaned, detailed, and repaired before sale. Detailing labor: $100 to $300 per car. Repairs: $500 to $2,000 per car on average. Across 30 cars per month, that's $3,000 to $9,000 in labor plus parts. On $240,000 gross, that's 1.25% to 3.75% of gross profit. Repairs and maintenance: 5% to 10% of gross profit. Used cars need fixes. Brakes, fluids, filters, belts. A $150 to $500 investment per car to make it saleable. Across 30 cars, that's $4,500 to $15,000 per month. Marketing and customer acquisition: 3% to 8% of gross profit. Digital advertising. Auction fees. Craigslist. Facebook. Google. Building traffic to the lot. Cost, 3% to 8% of gross profit. Finance and administrative, 3% to 7% of gross profit. Accounting. Legal. Compliance. Documentation. Loan origination. Cost, 3% to 7% of gross profit. The monthly economics for a typical single-lot dealership, a dealership selling 25 cars per month. 25 cars times $8,000 gross profit equals $200,000 in gross profit. Operating costs, inventory carrying, 20%, $40,000, sales staff, 12%, $24,000, detail and repair labor, 6%, $12,000, parts and repairs, 7%, $14,000, lot rent, 2%, $4,000, marketing, 4%, $8,000, finance and admin, 4%, $8,000, miscellaneous, 5%, $10,000, total operating costs, $120,000, net operating profit, $80,000 annual. Operating profit, $960,000 less debt service, $8,500 per month, $102,000, annual net profit, $858,000. This looks phenomenal. A single-lot dealership with $2.4 million annual gross revenue generating $858,000 in annual net profit is a 35% plus net margin. This would be incredible. But this scenario has massive assumptions. The brutal reality, turnover and carrying costs. The scenario above assumes cars sell in 30 to 45 days. But average used car holding time is 45 to 90 days depending on price point and condition. A 60-day average inventory holding time on 25 cars per month means you're holding 50 to 60 cars on the lot at any given time. Your carrying costs aren't $40,000 monthly. They're $60,000 to $80,000 monthly. Your operating profit drops from $80,000 to $40,000 to $20,000 per month. Suddenly the dealership is marginal. The reality of negative gross profit cars. Not every car sells at $8,000 gross profit. Some sell at $3,000 gross. Some at $5,000 gross. Some at $12,000 gross. But some cars are negative gross profit. You buy a car for $15,000. You spend $2,000 in repairs. You spend $1,000 in carrying costs while it sits. You sell it for $17,000. You've lost $1,000. This happens. Dealers carry 10% to 20% of inventory at negative gross profit just to move volume and reduce carrying costs on other units. What smart dealers do, the two-lot strategy. A smart dealer runs two operations. Lot A is the retail customer lot. Premium cars. $15,000 to $40,000 retail price. Higher gross profit per unit, $8,000 to $15,000. But slower turnover, 60 to 90 days average. Lot B is the wholesale/volume lot. Used cars. $8,000 to $15,000 retail price. Lower gross profit per unit, $3,000 to $6,000. But much faster turnover, 15 to 30 days average. By running two lots with different strategies, the dealer reduces average inventory holding time by 20% to 30%, reduces carrying costs significantly, increases return on capital, reduces risk of holding dead inventory. A dealer with $500,000 in operating capital can run both lots simultaneously. Total inventory might be 60 to 80 cars split across both locations. Instead of holding 50 premium cars slowly turning over, they hold 40 premium cars and 30 volume cars with faster turnover. Total carrying costs are lower. Total sales volume is higher. Return on capital improves 30% to 50%. The good scenario: two-lot optimization. You open with $500,000 in operating capital. You establish both a retail lot and a wholesale lot. Lot A does 20 cars monthly at $9,000 gross. Lot B does 30 cars monthly at $4,000 gross. Total gross profit: $180,000 plus $120,000 equals $300,000 monthly. Operating costs across both lots: $120,000 to $150,000, not double because of shared management. Monthly profit: $150,000 to $180,000. Annual profit: $1.8 million to $2.16 million. You've achieved 25% net margins across $3.6 million gross revenue. Debt service of $102,000 annually is covered easily. You're generating substantial returns. The bad scenario: single lot mediocrity. You open a single lot retail dealership with $500,000 invested. You target premium cars at $15,000 to $35,000 retail. Higher gross profit but slower turnover. You achieve 18 cars monthly at $8,000 gross. Gross profit, $144,000 monthly. Operating costs, $90,000. Net profit before debt, $54,000. Annual net profit, $648,000. This is okay, but your return on capital is only 130%. You're not taking advantage of the dual lot strategy that smarter operators use. Your capital is underdeployed. You could be earning $1.8 million annually with better strategy. What single lot owners don't account for: inventory velocity. The biggest mistake single lot owners make is not understanding inventory velocity. If your average car sits 75 days, you need 75 divided by 30 is equal to 2.5 times the number of cars on the lot compared to a dealer with 30-day turnover. Those extra cars cost carrying expense for no additional revenue. This is the invisible drag that makes single lot operations less profitable than they should be. The hidden advantage of scale: a dealer with 100 plus cars on inventory split across multiple lots has significant advantages. They can warehouse cars off-site cheaper. They can negotiate better insurance rates on volume. They can employ dedicated finance managers capturing origination points. They can access better wholesale inventory sources. They have pricing power. A dealer with 20 cars on one lot has none of these advantages. They're paying full freight on everything. Conclusion: the actual economics of used car dealership ownership. Owning a used car dealership is a capital-intensive retail business with profitability entirely dependent on inventory turnover and carrying cost management. Most single-lot dealers are underoptimized. Smart dealers run multiple lots with different strategies to improve return on capital. The money in used car dealerships goes to four groups. First, car wholesalers and auction houses capturing acquisition markup. Second, dealers with efficient operations and high inventory turnover. Third, finance companies capturing origination points and interest. Fourth, dealers who don't understand the power of the two-lot strategy and operate at suboptimal margins. The separation between dealerships that generate strong returns and those that generate mediocre returns comes down to inventory velocity and operational leverage. A dealer understanding that inventory carrying costs destroy single-lot profitability and choosing to run two lots with different strategies improves returns 30% to 50%. A dealer optimizing around gross profit per car without understanding inventory velocity underperforms. A single used car dealership with slow turnover and underutilized lot space will generate disappointing returns despite looking busy. A dual lot dealership with optimized inventory velocity and reduced carrying costs will generate strong returns. The difference isn't industry expertise. It's understanding the hidden costs of carrying slow-moving inventory and structuring the operation to minimize that drag. Here's what successful used car dealers won't tell you publicly. They're not making money on the retail car sale. They're making money on inventory turnover, carrying cost management, and financing. The dealer who understands this runs two lots. The dealer who doesn't understand this runs one lot and wonders why their margins are lower than they expected. If you're considering opening a used car dealership, understand that the industry rewards inventory optimization over individual car markup. Build your operations assuming you'll need to run multiple lots with different strategies. Plan your capital assuming you'll need sufficient inventory velocity to justify your lot costs. And recognize that carrying costs are the enemy. The faster you turn inventory, the more profitable your dealership becomes. The visible gross profit is seductive. The hidden carrying costs are where fortunes are lost. Run two lots. Reduce carrying costs. Increase return on capital. This is the path to dealership profitability.